American farmland is disappearing at an alarming rate. According to the USDA, the U.S. has lost 4 acres of farmland per minute since 2000. That's a land mass larger than the state of Florida lost to real estate development and soil burnout. All the while, the demand for food, especially healthy organic food, continues to rise as much as 13% annually in recent years. Farmland LP is one of the largest investment funds in the U.S. focused on the organic market, is ideally suited to take advantage of the dwindling supply of farmland and the rapidly increasing demand for food. Its strategy focuses on converting conventional farmland to USDA-certified organic regenerative farmland. They have a portfolio of more than 16,000 organic and sustainably farmed acres and a 15-year track record of success. Their goal is simple: to produce attractive returns for investors while benefiting the environment. In today's world of high inflation, volatile markets, and uncertainty, consider joining investors, including large institutional investors like Bill Gates and other family offices, and add farmland to your investment portfolio. To learn more about Farmland LP and the $250 million fund, Vital Farmland 3, currently open to accredited investors, click on the farmlandlp.com link or email ir@farmlandlp.com and tell them you heard it on the Med Favor Show. Welcome back, everybody. We got an awesome show today. Our guest is Jason Draho, head of Asset Allocation Americas for UBS Global Wealth Management. He's also the chair of the U.S. Investment Strategy Committee. Jason oversees the strategic and tactical asset allocation recommendations for over $1 trillion. Today, Jason's going to talk to us about the possibility of a roaring 20s decade for the U.S., which he's been writing about for about 3 years now. Jason, welcome to the show.
It's great to be here. Thank you for having me.
U.S. economy has been strong. You've talked quite a bit about it. A lot of people have been caught offsides by that. Why do you think that's happened? What's going on?
Well, I think if we go back to, let's say, the beginning of last year, 2023, when the consensus view was recession by the middle of the year, like starting by the summer, and certainly further exacerbated when the financial or the Silicon Valley Bank went under. And the way I would sort of think of it is, even going into that period of time, I think there was a misreading of some of the data for the U.S. economy. And the challenge is for anyone who looks at the markets and the economy is you're trying to sift out signal from noise, and particularly the noise from the pandemic and all the distortions, and apply essentially pre-pandemic economic models and analysis for the economic cycle in a time when that really wasn't applicable. And so looking at, say, deterioration in something like the ISM Manufacturing Index, thinking, this is a leading indicator, it's got a good track record, same thing with the yield curve, but not realizing, well, actually what happened was goods production far overshot back in 2020 and 21. Services was the other way. And then they're kind of swinging back. So I think of like a pendulum. Typically, the economy sort of moves somewhat in cycle, like not perfectly, but they generally move together. What we had in 2020 and 21 was like goods went this way, services went this way, and they swung back. So if you read this using typical signals, you're going to say, this is a ominous sign for what's going forward, when in fact, that was just the wrong signal to be looking at. So a little bit of, I always described it as people were misinterpreting normalization for deterioration. So they were kind of inferring the wrong signals on that. So that's one aspect. I think the other thing that, in hindsight, it sort of seems obvious. It wasn't so obvious going forward, but like how the households came out of the pandemic, the worst of it, in such good financial shape in aggregate. And I often say, like, in simple terms, what happened is the federal government wrote about a $4 trillion check to the private sector, and they funded it with treasuries. And so now you have this excess balance sheets, you've had this wealth effect. And also you've had households who've locked in mortgages at sub 4%, and now they're sitting on cash earning 5.5%. And they borrowed long at low rates and are lending short at high rates. So it's basically an arbitrage. That's a great business model, and that's essentially what, not all, but certainly a good chunk of US households. So you have a strong consumer, you have distorted data that people misinterpreted. You can see why it's been somewhat immune to Fed rate hikes, and the economy's done better than expected. So hindsight's 2020, we can say all these things, but I think those are, to me, the two key things: is misinterpreting the data and really underestimating just how strong the private sector was, and often saying, like, there's debt problems in the country. True, just not really in the private sector.
Well, you were one of the people that were really on the forefront of talking about this roaring 20s concept. I love a bunch of your notes recently. I wanted to ask you, by the way, what's with the thematic on rosé? What's the tie-in there? I haven't seen Pete Rose or Kissed by a Rose by Seal yet.
Oh, that's a good one. Yeah, Kissed by a Rose. I'd probably rather go that route than the Pete Rose route. So the genesis of the whole series began in kind of October of 21. And think about the context. There was a period of time in early 21, vaccines were being rolled out, the economy was opened up. You also had significant fiscal stimulus once Biden, the Democrats kind of took full control of DC. There was, I'd say, about a 2-month period, March, April time period, when people were talking about the roaring 20s. Inflation still was sub 2% even. The economy was growing rapidly, it was opening up, job growth was coming back, so all good news. Then you get the first 4% inflation print, and I think it was for April. That came out in May. And then, of course, it just went higher. And so by September, all that enthusiasm was gone away. And really the talk was, are we going to repeat the 1970s where inflation is high, the economy is going to stagnate? So a lot of pessimism. I was saying, like, this is a little bit overdone in terms of stagflation. The economy is still good. But there are also things that were going on that I think were being underrepresented in the overall discussion in the markets about the economy versus what people were kind of thinking, like focusing on the negatives. And some of them were the fact that there's been essentially a positive aggregate demand shock to the economy, massive stimulus, and we can debate whether that's good or not. But what it did do was take us out of an environment for basically a decade post-financial crisis in '08, where it was this lower for longer regime. And it was around, 2013, 14, when Larry Summers kind of reintroduced the secular stagnation thesis. We can debate whether that's a valid view of the U.S. economy, but the data is the data. And the economy had low rates, relatively low inflation, and low growth. And I would kind of argue that that was a decade where there's no problem with supply coming out of the GFC. High unemployment rates, a lot of excess workers, excess houses, spare capacity. There wasn't sufficient demand. What we got with the pandemic was certainly a supply shock, but also a positive demand shock. So it might have almost moved us out of one equilibrium that is lower for longer to something that has actually kind of moved us in a better trajectory. So that's one thing. The key part, though, was it felt like there's aspects of investment that were going to take place in the private sector, through government spending programs, which ultimately proved to be correct with the CHIPS Act, the IRA Act, infrastructure bill. And the other thing that's often understated is you can increase in signs of maybe business dynamism. If you go back to the mid-2010s, there's a lot of talk about U.S. growth is slower, it's less productive, it's less dynamic compared to what it was in 1990s. What's going on? Robert Gordon from Northwestern University wrote a book about just growth is going to be slower. And there's various reasons why that could be the case. But a simple data point I often like to look at is monthly formation of new businesses. And I think this comes out from either the BEA or the BLS. But what you saw is starting in the fourth quarter roughly of 2020, the number of new firms being created, it could be a small business like one person, it could be like a bigger company, was around 450,000. And it's been held that steady at that level, give or take a little bit, for the past 3.5 years. For context, prior to the pandemic, it was a slow rising trend and it was around 300,000 right before the pandemic hit. So there's a step change of almost 50% increase. So there's that element was going on. There's the great resignation. People seem to be more willing to take risks. So you have investment that's taking place, a little more risk-taking, it seemed like. This demand shock, sort of conditions that said we've kind of shifted maybe the economy onto a path that can be more investment-led, productivity growth, because you had digital disruption, people working from home, the way that they can unleash new business models. This is before ChatGPT, so it was unclear just how much that would play out, but that's kind of further exacerbated this story. So I added it all up. I kind of wrote a note, say this is where the rose piece comes in. I almost need maybe rose-colored glasses to look through all this negativity and see there is a positive story, and here's 10 reasons why. And so that was the genesis of it. Now, I kind of didn't think much of it middle of 22. The focus is on higher rates. Inflation is a problem. You can go into recession. And I actually had someone reach out at UBS, one of our advisors in Europe, actually I think in Greece. And he said he actually had a Greek client who reread the note, was asking, well, of these 10 factors, which ones still apply? And I went back and looked at them and looked at the data and realized probably 8 or 9 of them still seem quite applicable. And I was sort of surprised by that. So let me kind of do an update, drink a glass of rosé, kind of keep with the rose theme. So that's where the rose consistent theme. So it feels like there's a positive element of roses all along. So that's really the genesis of the idea. And when I look back now, kind of almost 3 years later, a lot of those things I would have said, if they play out, it leads to a pretty positive scenario for the US economy. And a lot of them are playing out in ways that weren't obvious back then, but it helps to maybe explain why the economy's done better than expected, why the outlook in some way, I think more people are thinking this could be the scenario that actually plays out with much better growth, perhaps higher inflation, multiple years, and not just opposed to pandemic phenomena.
It feels at this point, some of these structural shifts rather than pandemic anymore. And you talk through some of these mega trends. Would love to hear a little bit about which you think could really have the biggest impact. We're talking about capex boom, green energy transition, security, deglobalization, and of course, everyone's favorite, AI. What are your thoughts?
So after doing kind of shorter notes on this whole kind of Rose series, we decided, myself and my team, to let's kind of flesh this out in more detail in a formal presentation that came out last November. Kind of asking the question, could the US economy have another roaring 20s? And use the framework that if this plays out, really the template is like the 1990s and sort of what happened there. And there's already people talk about parallels with the equity markets that looks like the late 1990s. But if you think of the investment story, the Fed story, the technology with today it's AI, back then it was the internet kind of being unleashed on the general public. And we know what happened in the second half of the 1990s, that there was a productivity boom where productivity was going 2-3% per year. It led to rapid growth, disinflation. Ultimately, you could say it sort of contributed to like a bit of actually like an equity bubble. But the conditions today have a lot of parallels and similarities. And so if that's the case, well, that was really a positive supply story. And so to me, like for this to play out, we need to have a positive supply story. So like take economics 101, we can almost kind of simplify all the complexity in the economy, like aggregate demand, aggregate supply. A roaring 20 scenario means you're shifting the supply curve out into the left, which means faster growth, but lower prices, or at least inflation goes down. So what gives you a positive supply story? And will you get that? So we know there's certain mega trends that are playing out, like the energy transition. There's a lot of people talk about that, which it's the supply of energy. You can make the case that that's actually not going to be a positive for productivity growth because you have to invest all this money into essentially creating a renewable energy system at the same time you're running a fossil fuel-based system. So it's not necessarily productivity enhancing. Maybe it's actually inflationary to some extent. We talk about a capex boom. And partly there's certainly in the US, there's been a lack of investment for a number of years. There's a lack of real capex cycle in the 2010s. So there's almost just a need to replace and replenish the capital stock. But part of the argument there, and this is what gives me sort of more confidence in this thesis more so than just the AI specific piece, is if there's a lack of labor, or if there's like the labor market's tight, companies have no choice but to substitute capital for labor. Like that's just the basic economics. Like you kind of shift your relative, allocations. And historically, there's pretty good evidence that would say, when the labor market's tight, when wage growth is high, companies use capital, invest in capital, they make their workers more productive. And then 2-3 years down the line, you see productivity growth rise. I mean, that's a pretty standard kind of relationship. And sort of intuitively, it makes sense. So that I have sort of confidence in that you're going to get this capital investment story across different categories. That's going to give workers more capital to be hopefully more productive. So that moves the supply curve out. Things like deglobalization, global security, that is certainly not productive enhancing. The question of how much of a drag would be, but I think it's not a lot. AI is really the wild card in the story. And you see estimates of suggesting it could be barely moving the needle, and other estimates would say it could increase productivity growth from like 1.5 to 2.5, 3%. So if you think of trend growth as productivity plus your labor force growth, you're talking about going from a neutral rate of 2% to something closer to 3%. And that to me is sort of the thesis. If you get that, well, then you're growing faster and it's more productive. So you can also have inflation come down. So it's kind of the sweet spot. Productivity is the cure-all for all economic ills. You get more output for kind of without the rising costs. So that's how we break it down. I think we have pretty good confidence that the capex story will play out. And the data since we did the report last November is suggesting that. I mean, just look at, I think during the earnings season when Facebook or Meta, Google, Alphabet, and Microsoft reported how much they're going to spend on capex for AI data centers. It's $140 billion this year. And that's a 48% increase versus last year. So that's just one slice of this capex story. So it is playing out as we think. Now, when you get the productivity gains, this is a more open question because that's really hard to predict. But I would say the conditions you need to get that are certainly in place and the thesis could still kind of play out. And today versus 6-7 months ago, there's not a lot to suggest this isn't going to happen worse than it was then. And there's actually things I would say like it's still on track or maybe more likely to happen. And so to me, that's these mega trends, the CapEx one and AI in particular, the ones that if this plays out, this is going to be push us in that direction. It's a question of the magnitude rather than does it actually happen or not.
One of the kind of non-consensus views you guys tend to have is that growth could be quite a bit higher in the US than people expect. What does that mean? What kind of numbers you guys put to that?
I wrote a piece a couple of months ago and I titled like the 6% economy. And by that, I mean like US growth, nominal GDP growth has been running 6% or higher. We know that in 2021, it was over 10%. 2022 was over 9%. Last year was a little over 6%. You will see how it plays out this year, but again, it's probably going to be maybe in the 5 to 6% range. I think focusing on nominal GDP is important because when you think about where interest rates could go, you think about the deficit, what is real GDP plus what is inflation, that kind of says like this is how hot the economy is running. For context, in the 2010s, like literally from 2010 to 2019, that 10-year average, nominal GDP grew just over 4%. And you could split it almost exactly like 2% real GDP and about 2% average inflation. In the 1990s, from like 92, like after the recession in the early 90s through 2000, so about a 9-year period, it was 5.85%. And then in the 2000s, it was like about 5.3% from like 2002 to 2007. I picked 6% because it's a nice round number as opposed to like the 5.35% economy that's not as catchy. What I would say is somewhere in the 5 to 6% range, I think that would, to me, constitute sort of a roaring 20s environment, given how fast the US economy can go, given our population dynamics. But if we're going to do 5.25, 5.5 versus 4% last decade, you compound that over 10 years or something like that, that becomes a significant difference. And so I think that's, if I were to quantify what it means, to me, it means like an economy with a 5 handle in terms of nominal GDP growth, which in an environment where the deficit is over 6%, you kind of need the economy to grow at that level. It starts to have implications for interest rates. I would say a year ago, 2 years ago, that certainly would not have been at all consensus view. And I think it's still not a consensus by any stretch. But I think there's more and more people are kind of accepting like, oh, the economy could grow faster. Inflation will be a little bit higher. Growth is going to be a little higher. So I think bit by bit, people are shifting that way, but it's certainly not priced in the markets and the rates markets. And it's certainly not a consensus view at this time.
So you mentioned interest rates and inflation. Those tend to be tied at the hip. What's y'all's general views there?
Look, I think the path of inflation is to go lower over this year, over next year. I think it's going to be a bumpy path as we've seen this year. Some of it is that there's still legacy aspects of the pandemic that are causing inflation to go high. Like, for example, a big part of why inflation was high in Q1 was auto insurance. And then when this is not something that I was personally kind of focused on, but when you look at in March, your auto insurance was 22%, you're like, well, what's going on here? Then I talked to people who are the inflation experts, and actually people also who work in the industry that cover insurance companies. They were saying this is going to happen. And the reason it's going to happen is that these insurance companies were basically losing money in 2020, 21. People were driving more during the pandemic. They were on the road more. There's more accidents. To buy replacement cars, like used cars, those prices went up. So the insurance companies were basically saying, we got to raise our premiums. It takes them time to do that because they have to go to state regulators to get approval. So the implications of that really didn't start to flow into the data until say last year. And now we're seeing the effect of as people kind of renew their auto insurance, those rates are going higher. But we're not going to get 22% auto inflation going forward. I mean, otherwise no one's going to either drive a car or buy a car insurance. So that is likely to kind of moderate. So there's a lot of little examples like that that would give us confidence that this is not structural, it's not demand driven. It's a little bit idiosyncratic, and same thing with kind of rent and shelter. This is should all the leading indicators suggest it's going to come down. What's the path? It could be very gradual. We also kind of assume, and this is in our Roaring 20s piece, that inflation is not going to stay consistently above 3%. And for the simple reason is that the Fed just will tolerate 2.9%. They won't say that, but I think they will tolerate it, assuming the direction of travel is lower, but they're not going to tolerate 3.5% inflation on a sustained basis. And therefore, these talk about we'll have a 4 or 5% inflation, and I just think that's just not viable. So the direction of travel for inflation is lower. It might be, again, a very bumpy path. And the way I would sort of think about it is the Fed is going to use and wants to use, and maybe it has been using all along, the mid-90s sort of playbook. 94, they hiked rates 300 basis points, basically in 12 months, including a couple 75 basis point hikes. They held steady for about 7 months. They did 3 25 basis point rate cuts, and they held steady for about a year and a half. In hindsight, you could say lucky to some extent, but the idea was that we think inflation will come down gradually, which it did. And it took from, I think, when they were stopped hiking, inflation was 3% CPI. It fell to 1.8% by 98. So 3 years later, I think they're kind of looking at this is the playbook we want. We don't think we need to get a recession to get inflation back to target very gradually. Let's just sort of allow it to kind of glide lower. And therefore, we keep the economy running relatively hot. So going lower, I think, and then again, this is kind of where the markets are. Maybe that's not how they're thinking about the Fed, but I think that's kind of where investors think that. And frankly, I think the data would suggest that that's probably the most likely course of action for inflation at this point in time.
Yeah. So what does the Fed do in that scenario? Inflation coming down, growth being higher than expected? Are they going to start raising? Are they going to cut? What'd you do if you're Jerome?
Our official view is 2 cuts starting this year in September. We'll see, because we don't yet have the May payrolls report, the inflation report, and then, of course, how the Fed alters their updates on June 12th for the FOMC meeting, which my conjecture would be, unless the data is really off on payrolls or inflation, they're going to go from a meeting of 3 cuts to 2 cuts. I think it's kind of the most flexible, gives them optionality to change it later. If they went from 3 to 1, it's basically they're saying we're not doing anything until December, which I think that's certainly not where the market is right now. I think bigger picture, the Fed is, in some way, to me, has kind of tipped their hand over the past year and a half, 2 years almost, of anytime the inflation story has been a little bit better, they've almost changed their tune. That sounds like, okay, inflation is solved. We can be a little more dovish. we go back to March of 23 when Silicon Valley Bank went under, their willingness to immediately kind of step in and basically stabilize to prevent any sort of financial instability, because they didn't want the economy to go into recession. They're, I think, close enough to their price stability mandate that they can kind of give equal weight to the full employment. I think fundamentally, this is a Fed that's also kind of influencing a little bit like how they thought about things back in the 2010s. Yellen, when she was chair of the Fed, basically gave a speech in 16 or 17 along the lines of, monetary policy can't fix the labor market, like we can't fix inequality, but we can run the economy a little bit hotter, let people being pulled back into the labor force, because ultimately it's better for them to work and have inflation slightly over 2% than not work at all. So I think there's a mindset among the Fed officials, I'm going to probably include Powell in this, that is ultimately the better economic outcome for the economies. Don't push into recession, have inflation kind of run it a little bit hotter, because ultimately the net trade-off for segments of the population is probably better to be working, having nominal wage growth above inflation, starting to recover kind of real purchasing power, rather than trying to induce a recession, even if it's mild, to get rid of inflation. So that's my working assumption. Now, the conjecture also on the fiscal side is there's no signs that DC wants to, on either party, really tackle the deficit at this point in time. So if you continue to run a deficit of 6+% of GDP, you have the situation of fiscal dominance. Ultimately, does monetary policy have to serve fiscal policy if fiscal policy is not going to take any kind of measures to under control? The way you can do that is ultimately then, does that mean rates have to be lower, else equal, because the financing costs just continue to explode? So bias, you just want to have lower interest rates. Again, the Fed wouldn't say that's driving it, but I think in some way, like the fact that Yellen was Fed chair and now Treasury Secretary, they would talk. There's an element like, well, maybe this is the best approach. There's an argument that people would make that if you're running a loose fiscal policy, you have to have tight monetary policy to kind of offset that, to keep inflation contained. But if you do that, then it all means, well, then rates are probably higher, else equal. And actually, you might slow the economy. That's not good. If you run an economy where you're growing 5 to 6% nominal GDP, basic quick math would suggest, well, then maybe your tax receipts going to increase 5 to 6%. So then your debt is growing 6% a year, but your economy is growing nominally roughly 6% a year. At least that nominal debt to nominal GDP kind of stays somewhat stable and sort of buys you time ultimately to have a fiscal solution. Because historically, when you've had more in emerging market countries, big debt problems, there's only really 3 ways to solve the debt problem. One, you default, and we're not going to default on the debt anytime soon, probably not in our lifetimes. You inflate your way out or you grow your way out. So ideally, you want to grow your way out, but I don't think we can grow fast enough. So you probably need some sort of combination, which is why I kind of focus on nominal GDP. So to me, that biases the Fed to say, all right, we'll take a very gradual path to bring inflation down. We're going to run the economy hot. We want to grow it faster. That's the path the Fed's going to take. So I would be inclined, as long as the inflation data is going lower, any sign of growth weakness, they're willing to cut. I would characterize, in like the mid-90s, these are risk management mid-cycle cuts as opposed to we're reacting too late to the economy slowing down. I think that's the mindset they have. Now, whether they can pull it off, that's a different story, but I think that's some of the fundamental framework, despite everything else in terms of we'll talk about. But I think at heart, that's kind of the approach they're trying to take right now.
Man, I listened to you talk about the economy for hours. It can be dry, but this is fascinating. So this thesis plays out. Let's say that it does. What assets do you think are particularly well suited going forward, and which ones are not so much?
So this is where some of maybe the 90s parallels both are supportive and break down in different ways. So if you think of we're 95, 96, I'd say we're we're closer to 1996 than we are to 1999. The challenge for U.S. equities is that the forward multiple in the S&P is about 21 right now versus it would have been like mid-teens in 95, 96. So the scope for valuation appreciation was just much greater then. We know it went much higher. Like if we replicate that, we're going to go to like a 26, 27 multiple. You can't really forecast bubbles, but it just means all else equal, the starting valuation suggests the returns on equities certainly won't replicate the 20% annualized return we got in the second half of the 90s. That's fine. I mean, I think if we get high single digit type of returns, that's a good story. I think it's plausible to get that just because, again, an economy that's growing 5, 6% nominal GDP, that should translate into like 5, 6% nominal sales growth. You apply margin improvement there. So you can grow earnings mid to high single digits, even with no multiple expansion. Then you're looking at, again, high single digit type of equity returns. So I think that's a reasonable assumption. When people hear roaring 20s, they think of what happened back in the 20s, like a bubble, same thing in the 90s. My thesis is specifically on the US economy, but it's clearly going to impact the financial markets. And I think where you can get some of the excesses in equities is that if this thesis really plays out, it has to also be driven by the sort of technology story. Like AI has to start to show benefits enough that people think this is really impact the earnings story. I'm going to pay more for it. You get some frothiness there. So if you get faster productivity growth, it presumably means that this technology is actually legit. It's kind of bearing fruit on earnings, which then you can start to get investors think about, well, these valuations, not just for NVIDIA, as we talked about earlier, but some of the more speculative companies will pay a premium for that. So if you think about like non-profitable tech stocks, and there's baskets that different banks will look at, they were high flyers in 2020 up to mid-21. And then when rates started going higher, they crashed and they've never really kind of come back. Like they've been very much flatline. To get a real replication of that bubble, it's almost you need things like that to go higher. Whether it will or not, you're predicting speculation, which is hard to do. The one thing that sort of gives me, again, the analogy to the 1990s, I think it's more of the 96, is that aside from valuations for some stocks being elevated, we don't have a lot of the froth that we had back then. Like, just take the IPO market. It was on fire in that time period. In 99, the average first day return for IPOs was something like 70%. And in 2000, it was about 50%. And we're talking about 500 IPOs. This is not a small sample size. Right now, the IPO market is very quiet. It's basically been dormant for almost 3 years. So we don't have any of that kind of speculative excess since the IPO market cooled, since the SPAC kind of phenomena, a little bit of the meme stock that's going on right now. But again, that sort of played out by mid-21. M&A activity has been pretty quiet on a relative basis for a couple of years. It's not just the 1990s, but like the cycle evolves. At late cycle, that's when you get some of these excesses. Corporates are buying each other. You're just not seeing that. So some of the equity market excesses, we're just not there at all with the activity. And if we go back to kind of the part of the conversation of beginning of last year, the consensus view was recession. I think there's been a lot of investors have been kind of dragged, not kicking and screaming, but like in disbelief that the economy has done as well as it has, have been seeing the markets go higher, been sort of pulled in, but have never been sort of ahead of the curve where they want to buy a lot of risk. So I think positioning data would suggest a little bit of elevation, but it's like a 7 out of 10 at most. And in fact, maybe even dialed back to about a 6. And we know how much cash is sitting on the sidelines in terms of money market funds. So it's not everyone's chasing, doing speculation. It's nothing kind of like that. So from a market's perspective, a good economy should help equities. The speculation part isn't there. Whether it will materialize, that's the harder thing to predict. So directionally, I think this thesis is good for equities. An interesting question would be, is this better for tech that's done very well for a number of years, or is it better for other parts of the equity market? An environment where you look like you can have a long runway for the cycle, nominal growth is high, so you don't have to seek out just those secular growth stories to get growth. You can maybe get growth like industrials, for example. That macro environment could be beneficial and see the other parts of the markets outperform. But as we saw in the 90s, like that market was good, that economy was good, yet it was still the tech sector, the TMT sector at the time that did really well because the secular story is just so overwhelming. So I could see arguments for both cases. Like, is it still a story where growth does well, or is it a case where value, small caps, other things do well? Pros and cons I could see either way, but I'd probably be inclined that if this really takes place, it needs a secular story. People kind of be sucked in, like they need to own these growth stories. It's the most compelling narrative as opposed to like, it's great to buy Caterpillar. There's a lot of investment going on, but I'm not excited to buy that. I want to buy this AI stock that's going to change the world. I think there's some element of that could take place. I haven't done enough work to have a strong view on it, but I think there's cases to be made both ways. But if I had to pick one right now, I'd say it's probably more of the same that would sort of do well over that time period.
As you think about bonds in general, you've had this pretty, not totally unique period, but definitely a period of pain for a lot of fixed income investors the past few years. They're kind of still in it. Do you guys see fixed income as a reasonable, interesting area now? And are there areas in particular that seem more interesting than others, or not at all?
So I'd break it down from a tactical horizon, let's say to now to year end, and then think about it in a multi-year perspective. So if the Fed cuts rates as we expect, typically you've seen like 10-year decline around Fed rate cuts. If growth moderates a little bit, as we kind of think will continue to play out, there'll be some probably concerns about could the growth slow even more, so a little bit like kind of bid for treasuries. And we've already seen that just the past few days on some of these growth concerns. So if that plays out, high quality bonds look, I think, reasonably attractive on that horizon. I don't think you're getting paid on credit for a lot of credit, like corporate credit where spreads are pretty tight. In simple terms, if the macro is good, then equities have more upside. And if the macro is bad and we get a recession or something close to it, an equity sell-off, you're going to get the riskier credit sells off. I'd rather own high quality fixed income or even cash. So to me, it's a little bit on the spectrum. Like you think about corporate America, I either want to own like high quality equities or I want to own like really say fixed income. And sort of the riskier parts of the credit spectrum would look a little unattractive to me on a risk-adjusted basis at this point in time. If we think on a multi-year basis, the question starts to become, what role do bonds play in the portfolio? Because for 20 years, basically from 2000 up until 21, bonds, I'm talking like treasury bonds, were basically a perfect asset class in that they would give you a compound annual return of around 6+%, volatility of 4%, about a quarter of the volatility of equities, and they had a negative correlation with equities. So basically, you're getting paid to buy insurance that when equities sold off, bonds would rally. That's basically the bedrock foundation for like a 60-40 simple stock bond portfolio. It just worked ideally for 20 years. 2022, we know that was disrupted when bonds sold off a lot. The way I kind of think of it is, in simple terms, in a macro environment where if you think of either growth or inflation are the two factors that really drive everything, which factor for the market is more important? If you go back to the 70s, 80s, and 90s, it was really about inflation. Inflation was too high and it took a long time for it to come down. So it was really about like inflation was driving it. And during that time period, the correlation between stocks and bonds, if you take like monthly returns or weekly returns and kind of do a rolling correlation, over 2 years, that correlation was positive. It meant that bonds and equities would sell off together and they'd rally together. And the rationale is when you're worried more about inflation, if inflation, say, surprises to the upside, well, maybe the Fed's got to hike rates to cool the economy. When they do that, that's bad for bonds, but it's also bad for equities. By the late 1990s, inflation, effectively, you could say it was sort of solved in terms of it was now at 2% and it was holding steady. And we know for like the 2020s and 2010s, inflation was not an issue. In fact, in the 2010s, it was more of like deflation or disinflation risk as opposed to inflation risk. So if you're not worried about inflation, then really what you're worried about is any kind of growth shocks. And so that's kind of when the Fed put came into play. Like if you get a negative growth surprise, all right, well, maybe the Fed's going to ease policy, good for bonds, but the growth shock is negative for equity. So they kind of move inversely. So if we're now back in an environment where inflation is the more dominant concern, or at least it's back to be a concern that's roughly equal with growth, well, that negative correlation for 20 years, it's not going to be negative anymore. Maybe it doesn't go positive, but maybe it chops around to be sometimes it's positive, sometimes it's negative, which means that 60-40 portfolio, sometimes it works and sometimes it doesn't. And therefore, you need to think about what do you add to your portfolio to help diversify essentially equity risk, because that's what dominates portfolios. You need things that diversify equity risk, which could it be certain hedge fund strategies, things like that have low correlation to it. If it's an environment where inflation is a concern, it probably means that commodity prices are doing well for various reasons. So commodities become a natural hedge, whether it is base metals, oil, maybe gold. So these are things that we're thinking about, like, do we start to structurally add them back, not just tactically, but part of a kind of a long-term allocation. I think we need to get more comfortable with the macro environment to suggest like this is something you need to own and sort of own as a kind of permanent part of your portfolio. But I think the starting point is to recognize this macro regime is going to be different. It's not going to be as good for that sort of stock bond correlation. Therefore, you need to think about other ways to add diversification to your portfolio. So long answer to say, bonds aren't a negative asset class, but they're just not the ideal asset class that they were for so long. So I think that means you need to think about other things to add to your portfolio.
Like what?
Commodities is probably the first thing that you'd want to do. I think there's ways in which you could say, even with equities, historically, if inflation is a little bit higher, it means things like energy, materials historically have done better. So it kind of favors, like, these are things that maybe you want to have larger allocations than you normally would. Real estate, infrastructure, things that could also be a little bit more inflation hedged. Like with infrastructure, if you can basically raise your prices in line with inflation, it allows you to hedge them out. I think on a long enough horizon, equities tend to be able to absorb equity shocks better because ultimately companies can kind of pass that on, even if the initial shock is a challenge. And I think we've seen this in the past few years. I think there's opportunities, and this is less about the macro environment, like opportunities in the private markets that can help deal with some of this. Part of it is just the private market opportunity set has just grown so much, and it's likely to continue to grow, that if you only look to public markets and public equities, you're basically leaving pretty sizable kind of set of investments off the table. So that's something that we talk about with our clients. And some of it is, frankly, getting investors to be disciplined and stay long-term. There's more and more, and not just retail, but institutional investors who think, if I don't have to see my statement every day, don't overreact to the volatility. And if I see quarterly statements, it might allow me to kind of stay more committed to a plan, even though on a quarterly basis, there might be periods of time where both stocks and bonds sell off. Now, if you go to illiquid asset classes, in some way, it sort of addresses that problem. I've heard some well-known investors make the comment that there used to be an illiquidity premium, like you got to get higher returns from going into private markets. Now there might almost be a slight discount because I don't want to see the mark to market. I want to see quarterly statements because it smooths things out. So, I mean, that's a little bit of behavioral aspect, but I think all these things collectively are part of like, as an investor, what's the toolkit I need to make sure that ultimately I stick to the long-term plan? There's probably going to be more volatility. If correlation between stocks and bonds is a positive versus negative, it just means all else equal, that stock bond portfolio is more volatile than it was before. So then how do you want to maybe dampen out that volatility? In some ways, is other asset classes, some ways just don't look at every day because frankly, long-term, that ends up being smoothed out.
Someone who's got his hands on the dials of quite a bit of assets, how do you guys think about when you're positive on assets, negative on certain ones? How do you think about turning the dials? Is it sort of a tolerance band range? Do you guys have step functions? How do you go about thinking about how to prepare for these various markets and regimes?
Do you make tactical adjustments to long-term allocations? A risk budget that you can go overweight, just simple terms, equities versus bonds, and up towards, like, say, 10 percentage points deviation relative to a long-term benchmark. That's about how much, on a tactical basis, how much risk we do want to take. Then the how much we actually want to use of that sort of risk budget comes down to, like, what is our conviction level on the overall direction of markets, either up or down, or is how much of it is it a pro-risk on environment? So back in 21, when everything was sort of as a tailwind, you had very loose monetary policy, supportive fiscal policy, the economy is opening up. It's easy to say in hindsight that equities are going to go higher, but it felt like this is an environment where this markets are going to just keep kind of moving forward. Earnings growth is going to be there. So we overweighted risk assets versus kind of safe assets quite significantly. So, well, kind of the conviction levels there, I think the past year or so, there's been such oscillation of the equity markets and even fixed income markets. Is this an environment where it's recession, soft landing, no landing, stagflation? There's been very sharp turns. So it's hard to have high conviction to make a big directional call, in my view. And I think that's not, I think, alone. I think a lot of people have been, we get the macro calls wrong too much to have a high conviction to make big bets that way. But the way in general, I think we'll also think about things is anytime there's an asymmetry with an asset class in terms of return, that becomes attractive. And with that, I mean, suppose your view is that something is going to do well, like the rates are going to rally, therefore bonds are good investment or equities are going to do well. What's your downside if you're wrong? And then what's your upside if you're really right? And if it's asymmetric, we're like, if we're wrong, we don't lose very much. But if we're right, we do well. And if we're really right, we do fantastically well. That becomes a compelling opportunity. Last October, when the 10-year hit 5%, to me, that was a point where, like, this feels like a pretty asymmetric opportunity to lengthen duration of portfolios. I remember, like, talking to some clients who had sat in 60% of their portfolio was in cash for a year and a half. They felt great as rates rise, like they were kind of sitting on the sidelines. It wasn't impacting them. But I say, like, just the basic math you can work out is that 1 year from now, if the 10-year yield stays at 5%, well, you've got a 5% return. If the 10-year goes from 5% to 6%, that's basically the break even. Now, the price loss fully offsets that 5% interest essentially you're getting. So worst case scenario, realistically, you're going to be zero over the next 12 months. Holding steady 5%. But if rates go lower, as we think, well, you could be 10% plus. If they go to 3.5%, you're up 15 to 20%. So if that's your distribution of, like, zero is worst case, maybe base case is like 8 or 10% on a 10-year treasury, and it could be up mid-teens. That feels like it's a pretty attractive investment to kind of allocate. And the timing was such that within 2 months, the 10-year was back below 4%. So in 2 months, that trade might have made about 13 or 14%. It's not often you get these kind of extremes, but when we get it, that's when you think, well, this is an opportunity where it feels like it's just a compelling situation to kind of make bigger moves. So we look for things like that where we can feel, in this macro environment, there's not a lot of certainty of how things will play out. Where are those asymmetries? Where are things that are sort of dislocated? So if we're wrong, we don't lose too much. If we're right, it's kind of levered to really kind of outperform. And every now and then they materialize. And then when you do, I think that's when you got to take advantage of them.
There's a couple assets that haven't come up yet. At least I don't think they did on the word cloud. Precious metals, gold's near an all-time high, and real estate and REITs, maybe a sort of tangential one. Anything in the other world of other periphery assets that you think is particularly interesting or newsworthy or not?
So gold is interesting because it's done very well. It's a question people have been asking this year is like, why has it done so well? For a decade, if you just plot the price of gold and the 10-year real rate, like on tips, they basically move together, but inversely. So the higher rates go, the lower gold goes because it's just an opportunity cost. You're not getting any interest payment from gold. So, like, if I can sit in a treasury and get like 5%, why do I want to hold gold? That relationship is broken down for about the past year. If you just continue that relationship, gold should be at like 16, 1700, not 23, 2400. So it sort of begs the question, well, what's driving it higher? Is it some of the flow story? Because there's definitely data on how central banks are accumulating gold as to diversify their portfolios. So maybe there's a bit of a structural just supply-demand imbalance that could be driving it higher. It could be a little bit of, like, this is telling us something. It's telling us that we are going to be in a higher inflation environment, maybe higher nominal GDP growth environment kind of going forward. And gold is the canary in the coal mine of kind of that situation. I think there perhaps is something to that. There doesn't seem to be a lot of speculation because if you look at ETF flows into gold, it hasn't really been sort of say like people are just buying gold for those reasons. All of which then sort of makes it to me a little bit intriguing, like in an environment where growth and inflation could be elevated, if commodities in general are kind of a good hedge, it might be something that in our base case, gold doesn't work, but if I'm wrong, it could be something that performs well. So again, thinking about more of a diversification perspective of a portfolio, I think gold is interesting in a way that generally we don't recommend allocating to gold, at least as a core part of your portfolio, because you can go back 40 years, you can go back 100 years, and the data would tell you that gold has returns that are comparable to bonds, but volatility of equity. So if you take a long enough horizon, like 100 years of data, which that's not in the quadrant of attributes that you want, right? You want equity returns with bond volatility. So gold may be a different regime that can last multiple years. So that's something we're thinking about. On real estate, it depends on what part of real estate you're talking about. Obviously, commercial still remains somewhat challenged, but something that we're recommending is high quality CMBS. Think like an equity tranche or like they're kind of the high AAA kind of tranche. Spreads had widened out a little bit of kind of baby with the bathwater. When spreads probably widen too much, they're going to compress. It's not going to be quite as bad as people fear in that space. As a sector, though, like a sector in the S&P 500, I'm more concerned about that because there's probably still more headline pain, if nothing else. Maybe it's not fully priced. Earnings growth could be revised down. So that's a sector that we think would outperform. There's also parts of real estate like data centers that's still like this is a structural story. It's probably a secular story tied to AI that still looks attractive.
As we start to wind down here, you already have a pretty non-consensus view, I feel like, but is there anything else? And it could be a framework. It could be a view that you sit down with all your peers at lunch in New York tomorrow and you say this and they say, no, Jason, don't agree with you there, or you're a moron, or what are you talking about? Is there anything that comes to mind? Any beliefs you hold that are most of your peers would say, huh?
I say there's a consensus view that I would probably don't think is warranted. On the macro front, a lot of talk about like deglobalization. And you mentioned like sitting down with friends for lunch in New York. I kind of think of like deglobalization as a term that people in parties on the Upper West Side or Upper East Side, they want to sound smart. They say, oh, there's deglobalization going on. Like it's a kind of a buzzword you can talk about. But I think like, is that actually really going to happen or has it happened? And I'm a little bit skeptical, even as a multipolar world, that deglobalization is happening. The pace of globalization we already know was moderating. You look at this trade, global trade as a percent of global GDP, it was running almost 2-to-1 in the 90s, 2000s. And then by about 2013, 14, it kind of flatlined. So it was kind of growing in line with global GDP. The share of global trade as a percentage of GDP is over 60%. In the mid-90s, it was like in the 35 to 40% range. So at some point, there's like only so much you can trade globally. You can't trade going out to get a haircut. You can't trade a dentist appointment. You can't trade even a lot of services. There's almost probably diminishing returns that would have maybe happened regardless of any geopolitical tensions. So that's one thing. So I think we're a fully globalized world. What we're doing is kind of shifting around where that sort of trade takes place. So whether it's nearshoring in the US or the China plus one strategy. So you have some production in China, you have production Vietnam, India, somewhere else. So to me, like it's this deglobalization idea sounds kind of a catchy buzzword. I think in practical matters, I'm much more skeptical that we're really going to sort of somehow retrench after 40 years of moving that direction. I think the world is what it is. Maybe it doesn't get more kind of globalized. Maybe there's a little bit of regionalization. And as a global asset allocator, there's actually maybe some benefits to that because as the world moved in further synchronization, it made it actually harder to diversify because everywhere in the world is sort of moving together. So if you have different pockets of regions, like it's not so bad if the Fed is raising rates and China's easing rates. That actually helps diversify if you want to think about kind of diversification.
I tend to agree with you on this one. Maybe you and I will be at the end of the table and disagreeing with everyone. As we look out to the end of the year, next year, anything you're working on, you got you confused or excited or scratching your head or waiting for something this summertime as you put pen to paper?
So it's interesting as we kind of go into the summer, and we'll see what happens with the data and the Fed and whether it sort of changes the narrative in the market going into the official start of summer. Because it did feel like to me that there's been three scenarios that investors have focused on this year. Like there's either soft landing, hard landing, or no landing. And I'd say since the beginning of the year, like the hard landing scenarios, like that's 10, 15% of investors would say that that's my base case. Like it's relatively low. Soft landing is majority, but it might be like 10 on hard, 50 on soft, 40 on no landing. And certainly in April, that no landing went out as the labor market seemed to like it was accelerating. Inflation was high. Maybe the Fed has to hike rates. Now I think we're kind of, I'd say it's almost more like 70% soft, maybe 20 or 15 and 15 on the tails, which is kind of why volatility in the markets has kind of come down because everyone's sort of narrowed down to the simple path. And if you think about like between now and year end, just take the Fed, that it's pretty consensus. Like the Fed's either not going to cut rates at all, they're going to cut once, or they're going to cut twice. It's very unlikely they cut more than twice, given where the economy is. It's almost certain they're not going to hike rates. So that's a pretty narrow path for this calendar year for how it's going to play out, which means if that's the case, it's not a lot to jostle the markets barring some sort of shock. So I think what will happen in the summer, as we get in the second half of the year, it'll be less about like, how does the rest of the year look, but like, how does 2025 look? Because when we look to 2025, I think there's actually a much greater range of how things could play out. So suppose we're still in a no landing scenario, well, maybe the Fed actually has to raise rates. So I think that's still a possibility for next year, but it's not for this year. Or suppose the economy actually slows a lot and the Fed has to cut a lot. Maybe they end up cutting twice this year, but like 8 times next year, like 300 basis points in total, something like that. There's a lot of debate about how restrictive is Fed policy. I just had lunch with someone who thought like policy is really restrictive. You saw John Williams, the New York Fed president, gave a speech in New York last week saying, I still think neutral is around 2.5, therefore policy is restrictive. Yet Bill Dudley, former governor of New York Fed, had a Bloomberg editorial a week ago saying policy is not that restrictive. So all of this kind of comes down to like, what is neutral for policy? How much will the Fed cut? If this is the mid-90s, they might cut 3 times and they're done. And the market's not priced for that. So I think one of the debates in the market in the second half of this year, starting in the summer, is what does 2025 look like? Where does the Fed go? Are we a 4% economy, 5%, 6%? And I think as people start to kind of shift their probabilities around those scenarios, not so much around the second half of this year, that could lead to some market volatility. So I'm kind of thinking almost more about like, what does next year look like, as opposed to what does the second half of this year look like? Because it feels like that trajectory is pretty clear, barring shocks. But it's like once you kind of go there, it's like the distribution really widens out. And that's, I think, where the markets are going to start to grapple with as we move into the summer.
2025. It's hard to even pronounce for me. Feels weird even saying it. What's been your most memorable investment over the years? Good, bad, in between?
Well, I think the most memorable investment is, for me personally, probably came back in like the fall, fourth quarter of 2008, when the financial system was melting down, to step in and willing to buy some fixed income when yields and spreads were really wide and those markets weren't functioning. And then a little bit later in the winter to buy equities at a point when people really thought like, could the economy sort of implode and could we go a decade of depression, and to sort of buy at a time where like, no, this is kind of go back to my asymmetry point. Like we're already at an 8 multiple in the S&P. Like how much worse can things get versus if things are okay, there's a lot of upside. So I kind of think of, that was still relatively early in my career, being willing to kind of step in and sort of, do the Warren Buffett, buy when others are fearful, as opposed to buy when everyone's kind of very optimistic. So I think of that as pretty formative in my experience to like be willing to take the other side when there's a lot of pessimism and realize that usually things turn around.
Easy to say, hard to do. Jason, this has been a blast. Where's the best place for people to go follow along your writing, your podcast, anything else, your ideas, what you're up to? Where can they find you?
I think the easiest way for people to find my stuff is I'll post it at LinkedIn under my name, Jason Draho. You can find me there. So all my notes, reports, podcasts, it's all posted there. You can follow me. So if you want to get regular updates on current market views, but also the whole Rose series of reports, and I'll keep in mind Kissed by Rose. I may borrow that. So that's probably the best way to find everything I produce.
Jason, thanks so much for joining us today.
Well, thank you for having me. This is a great conversation.